Good afternoon, everyone, and thank you so much for joining us today. We are going through and some big changes over the last probably 3 or 4 weeks since we first invited you to join today's webinar. But we'll be going through navigating uncertainty, key tariff and market updates. And like I said, I think some of the market updates will be a little bit different than what we were seeing and maybe even expecting to a certain extent not too long ago. But we'll go through, the latest data and updates that we're seeing in the markets, latest updates on tariffs, and get into just what we've been seeing so far year to date and in the economic environment. So for today, as I started saying, we'll look at quarter one and I guess half of quarter two as we are in mid-May already, which is pretty unbelievable. We'll talk about economic overview and what we're seeing in the data. Uh, Paula will talk about Fed policy dilemma, kind of what we're seeing there and how we're seeing a little bit two different paths versus what we've seen over the last couple of years. And lastly, we'll just get into a little bit of the tariff impacts, expectations, and just some general market thoughts and themes that we're seeing as we are analyzing all the data and looking at markets in terms of portfolio construction and what we see ahead. And so, just a quick recap, and even some of this data, we ran it yesterday afternoon, but even as of this morning, believe it or not, the S&P is in the green. We had a year to date. We've had such, I would say, volatility and uncertainty over the last few months. But when we look at the different indices right now, the Dow Jones is essentially flat, a little bit up. S&P, like I said, was down as of yesterday, closed the day higher, and we are now positively in the green, which is great. A little bit of lag with the Nasdaq, not by much, but some of those bigger, growthier companies being hurt by tariff and uncertainty from a few weeks ago, but they have been storming back, and kind of in the lesser camp right now continues to be small caps, Russell 2000 index, and we'll get into a little bit what's driving some of this different market performance. And as you can see, bonds so far year to date, that U.S. aggregate index up almost 2% year to date. We're only halfway through the year, showing some resiliency, and it's been a pretty good area to be invested in. We'll talk about what we've done and changed somewhat recently in the portfolio. Not a big change, but a little bit into the strategy with fixed income. We always kick off these meetings and presentations just kind of giving you a high overview. I would say not much has changed. I think we position the portfolios to not only withstand some of the volatility that we've seen over the last few months, but also taking advantage of some of the growth opportunities. So we continue to be overweight U.S. equities. We continue to like growth in the tech sector, even though we've seen a little bit of a lag year to date and with some of the uncertainty there. Quality factors, again, with particularly the uncertainty with the economy, fears of tariffs. These areas of the market have continued to hold up quite strong through that uncertainty and volatility. And I think even as we move forward, are a good area in the markets. And I have some charts to show you why we feel that way. And I talked a little bit about sort of change to some of the portfolio structure on the fixed income side. We went into a little bit longer duration bonds. We moved a little bit away from short duration bonds. And the thinking to that was we got another rise in interest rates. It happened with, again, a lot of the tariff volatility. The bond market sold off, creating higher interest rates, and especially on the longer end. And so we thought it was a good opportunity to lock some of that interest rate in. We're seeing at highest levels in 17, 18 years. And so again, we want to make sure we're taking advantage of that where we can, and it gave us a good opportunity to do so. We continue to be underweight international stocks, and I have some good slides as to why we think that way, and we'll talk about the first quarter because there was a big discrepancy between international and the U.S., but we'll talk about what we see moving forward. We'll get into we're underweight, trying to gauge maybe specific sectors per se, mostly because of, like I said, some of the changes in policy and uncertainty. Winners and losers happen almost by the day, by the week. Small caps, we trimmed that at the end of last year continue to be underweight. And again, we can talk about why that is. And lastly, going to that discussion about going to longer dated bonds, we trimmed our exposure to short duration, wanting to take advantage and lock in some of that better rates on a longer term basis. So I think from a portfolio overview, that's where we stand. Like I said, not too many major changes. And with that, I'm going to turn it over to my colleague Paulo LaPietra to go over a little bit of the economic data and what we're seeing out there.
Thanks, Ryan. So where I really want to kick off this economic overview is looking at GDP growth. And this was important because actually last quarter was our first negative GDP print that we have had since the first quarter of 2022. And when we had a negative GDP print and also all of the tariff conversations that we've had over the last month and a half, this has caused a lot of concern in the markets. But what I really want to do here is peel back the onion on this and look at the underlying factors within GDP. And we could see that at the top of this chart. We could see consumption, business fixed investment, government spending, residential and net exports as all the contributors. And the consumption, which is the largest contributing factor to GDP, over 70% or right around 70%, was actually positive last quarter. And so was business fixed investment, was also expanding at 1.3%. What really was the drag on GDP growth was that net exports at negative 4.8%. And really what's going on there was just a lot of companies importing a lot of goods and materials trying to get ahead of the tariff situation. So if you actually, kind of peel that off and see that as more of a one-off with given that kind of climate, the overall quarter was a positive GDP quarter. It was just really that net exports that ended up being a drag for that last quarter. The other thing I always like to highlight is the US labor market. I always talk about how this is the foundation of a strong US economy. So here we're looking at US non-farm payrolls on a month-over-month basis going all the way back to January of 2021. And we see that, pretty steady decline coming off of 2021 and 2022, which was that COVID boom that we saw. And now we're more in that sustainable pace. And I've talked about this many times before. When we think about the labor market, we need to think more of a marathon pace rather than a sprint pace. And that's exactly what we're achieving here over the last year or so. We actually just got some good employment numbers earlier this month. So we got April jobs numbers, and we could see that at the top right of this chart. The expected amount of jobs created was around 130,000, and we actually came in at 177,000. So another really healthy sign from the US labor market that we're really in a position of strength. Now, some areas of concern has certainly been consumer fatigued, right? The consumers been doing a really good job of a lot of spending over the last couple of years, but now we're starting to see some material effects of this. So this chart right here is actually looking at credit card delinquency rates going all the way back to 2001 and 2002. And what we'll see is in 2001 and 2002, we were actually hit the highest, right, the peaks of delinquency rates for the lowest income households of 10% and the highest income, that top 10% households within the United States. Now we came significantly off of that over the last, 2 decades, but now we're right back near those numbers. So we'll see the lowest income households are right near that peak level of 2001 and 2002, and the highest income households as well. But I would be remiss to, to say really the stark differences between the two, right? Because the highest income households here, yes, we're at all-time highs like we saw back in 2001 and 2002, but we're still only around 5%. That's not really that much of a concern. But where the real concern comes in is that lower income 10%, where we see that level near or above 15%. So this is something that we've been monitoring, and we're going to continue to monitor as this is showing some strains on the US consumer. And finally, what I really want to point out is the US consumer sentiment. This is a great chart that points out the correlation between how the US consumer is feeling about the markets and what the market does on a subsequent 12-month basis. So if we look all the way to the top left of this chart, we're seeing 9 sentiment troughs. So when the consumer is feeling least optimistic about the economy, we'll see that the S&P 500 over the next 12 months averages around a 25% gain. And we'll also see in that same box in the top left, the 10 sentiment peaks. So when the US consumer is feeling the most optimistic and most confident about US markets, the US, the S&P 500 only averages about a 4% gain over those next 12 months. And this is important because if we look all the way to the bottom right of this chart, we're going to see that green dot that says April 2025. So April of this year, we hit one of these troughs, right? The U.S. consumer was really not feeling optimistic based off off of all the tariff situation and everything that was going on. And this is a good economic indicator that we could see some positive gains. And we've already started to see this right off of the bounce from the market lows that we saw back in April from the tariff. So this is also pointing to potentially much more capacity on the upside as well. Now, next part of the presentation, I just want to talk about the Fed's dilemma and specifically where we're going to be bringing interest rates from here. And to really think about where we're going to be going with interest rates, let's understand currently where we sit. And we still sit between that 4.25% and 4.5% federal funds rate. And we see that pointed out right here on that gray dot that says 4.38%. Now, what's important here is to now understand where the Fed wants to take us until year end and what the market is expecting. So the Fed is forecasting anywhere between probably two Fed funds cuts totaling in 50 basis points. And that's what we see right there in that blue dot that says 3.9%. But the market is much more optimistic on exactly how much the Fed's going to be cutting this year, where they're kind of calculating in a full 100 basis points cut this year. So 4 separate cuts to bring us down to 3.43%, which we could see in that green dot. And what's really going to be the driving factor on this is where we go and where we continue to go from here on inflation. So let's take a look at that on this next slide. So one of my favorite charts here, we're looking at an inflation heat map. This is actually looking at headline inflation going all the way back to 2018. And headline inflation encompasses all areas of the economy, right? So that's energy, shelter, food at home, core goods, dining, auto insurance. So really encompassing everything. And we'll see back in June of 2022, we hit all-time highs in inflation, right? We had 9.1%, and we've been steadily coming down and making significant progress on our fight against inflation. And we've continued that all throughout 2024 and so far in 2025. And specifically, we actually got some key inflation data yesterday. We got headline and core CPI, and we could see that on the chart to the right. This is broken out headline CPI and core CPI. And the market was forecasting that we were going to see an annualized rate of 2.4% on headline inflation year over year. And we actually came in at 2.3%. So again, less than what the market was expecting. This is a really good sign and should be giving the Fed ammunition towards being able and having the capacity to continue to cut rates this year. Now, what we really need to take a look at, though, is still the uncertainty around the tariff situation. And I don't really want to take too much thunder away from Ryan, but Jay Powell in his last presser was talking about, and I think he said uncertainty, too many times to count, but that's really what's at the Fed's forefront. Yes, we've made a tremendous amount of progress on our fight against inflation, but there is still the unknown on the impacts from all of the tariffs that potentially, we could see. We have seen resolution with the UK. We have had a 90-day pause on others, but again, there's still that potential that more tariff implications are down the pipeline. And that's why the market right now is only pricing in around a 92% chance that we hold rates at the next Fed funds meeting, which is in June, even though the Fed has come out and said we're probably going to be cutting rates, additional 2 times this year. We're still going to be holding rates for the time being. If we do see cuts, it's probably not until the back half of this year. And finally, what I want to take a look at is what this means for bonds. And I really do love this chart. We've looked at this chart before, but what this chart does is it shows us the outcomes on three possible scenarios, right? The first scenario, which is going to be highlighted in that dark blue, is what bonds are going to do if there is a 1% fall in interest rates. The next is the light blue, which shows if there's no changes in interest rates. And then finally, in that gray bar, we're going to see what happens if there's a 1% rise in interest rates. So what we'll see across all, the whole entire bond spectrum, which is treasuries, corporates, convertibles, high yields, municipals, the whole 9 yards here, we're seeing if there's a 1% fall or no change, this is a really favorable environment for bonds. Now, on the flip side, we're seeing if there's a 1% rise in interest rates, which is a bad environment for bonds. We talked about this before, that inverse relationship with bonds. We'll see that the impact is pretty minimal, especially compared to what the upside is with no change or 1% fall. So the outlook and the risk versus reward properties of bonds are really attractive. And that's really in the identity of our fixed income sleeve. Ryan kind of pointed out a little bit earlier how we've gone away from our shorter term bonds, gone into more longer term bonds. We really think that this is a favorable environment for bonds, and we're going to continue to have that outlook and ingrain that into our fixed income sleeve moving forward throughout this year. And then the next part of the presentation, I'm going to pass it back off to Ryan.
Great. Thank you, Paulo. And, from here, we'll go into some of the tariff impacts, looking ahead, and again, just some general market themes. And I forgot to mention at the beginning of the presentation, we do have a Q&A section within the PowerPoint, within the Zoom software. So if you do have a question, if time permits at the end, we will try to answer it. Otherwise, if you do have questions, you can always follow up with us after the presentation. But if you do have some, feel free to send those questions through the Q&A at the bottom of your PowerPoint presentation. So just for some general context, I think we have all known how crazy these last few months have been from a tariff perspective. But I thought just snapshot looking back over the last 115 years or so is just a great indication of sort of what that level of volatility that we saw in 2025 and what it meant. Now, the good news is given how sharply it rose, and as of 5 days ago, the overall tariff estimate was about 20% on overall imports. That's been essentially cut in half since some of the trade deals with China, or at least the 90-day pause with China. So that's a good thing. We're closer to about a 10% tariff rate, which is kind of what the administration has indicated they want to do with most countries across the globe. It's still quite a steep, increase from where we were at before, maybe high 2%, around 3%. You can see even the change from Trump 1.0 back in 2019. We had a little bit of an increase from a below 2% tariff rate closer to 3%. We were able to get through that, now at 10%. Will that last, and what are the further impacts? Hard to say. It still is a pretty big jump from where we've been. But as we know, fortunately, corporate America can be pretty resilient during times of uncertainty, as we've especially seen over the last 3 weeks. As we get into the next slide, that was a snapshot of about 115 years context. When you look at snapshot of the last, let's say, 4 months, markets hate uncertainty. And I think with the amount of headlines and changes that were taking place, you saw the market react accordingly. And I don't think it's any surprise when you look at this chart, right? I think some of the first announcements were back in February. Then it really heated up in March into early April. And that's where you saw the most downside volatility within the S&P, within the NASDAQ. And again, I don't think it's a surprise that over the last month or so, especially before kind of the announcement over the weekend, it's been pretty quiet. And not having maybe the day-to-day headlines, having a number of different advisors coming out, maybe saying things that even contradicted what they were saying the day before, has been good for the markets, because we've seen a steady progress and growth of stocks since they bottomed out in the beginning of April. And like I said, that kind of coincides with There were some good announcements back then, but I think the lack of announcements and lack of headlines has also been a really positive indicator for the market since that point. When we look at just some of the comparisons, I know we shared in our State of the Economy, we had a great chart indicating the Trump put, right? And that was essentially what in the first trade negotiations back in 2019, what that level that the administration was willing to sort of withstand in the market from a downside perspective when they kind of reversed course and eased up on some of the tariff restrictions. The blue line is sort of that year of 2019 showing how markets declined. The red line is what we saw so far in 2025. And that Trump put was much lower this time around. And we really felt that volatility. Again, I said we had bottomed out in April, or April 8th was the market low. But we did see some tariff pauses. And the market at that point was down around 20%. Like I said, it was almost down double what we saw back in 2019 during the first go around of this. So it did certainly inflicted some pain, but again, with some of the bounce back, some of the pauses, and it was part of our commentary. I think we shared it again at the State of the Economy and some of our quarterly write-ups. Is that during this time, and it felt really, really scary and really, really uncertain. But all it would take is maybe one positive headline, maybe another positive headline to really have this market bounce back. And again, that's kind of what we saw. And so, I do think it goes back to that element of not panicking, staying the course. And so far that has played out. Obviously, we don't have a crystal ball of what's ahead, but you see how quickly the V-shaped recovery has been over the course of the last few months. And, again, I think what really helped this, and this just shows a chart of first 100 days of different administrations over the last 100 years. This policy created the worst first 100 days of any presidency dating back to 1929. And so you see that in the blue line, Trump's first 100 days from 2025, what we've seen in the average in kind of that 10 to 90% range. The markets certainly help dictate, I think, policy in this case. And, that can be seen as we move forward as a good thing. I actually think that's a positive for the stock market as we move further in this administration, is that, there is reaction and there could be pushback by market participants in terms of maybe policy and trade negotiation. So I do think, even though it was a really volatile time, even though it was at certain points pretty scary in many ways, and speaking with a number of clients through that period, what we saw in terms of what the market did and how it kind of helped reverse course on some of this policy, I think moving forward is going to be a good thing. So let's just dive into one of the topics that I think made a lot of headlines outside of just tariffs and what we were seeing there. But in terms of the stock market, there was a lot of discourse over U.S. stocks versus the rest of the world. And what we saw in the first quarter was, frankly, pretty steep outperformance from international stocks. And we hadn't seen that in quite some time. And as you know, we're mostly invested in U.S. stocks in our equity allocation. So wanted to just talk about this, what drives some of those decisions, what we're seeing. And, I laid a chart here over a little bit more than 2 quarters. This goes back to the start of Q4, so October 1st of 2024, extended actually through yesterday's or the day before its close. We ran this yesterday morning. The red line is US, the S&P 500. The blue line is the MSCI World Index, not including the USA. So as you saw in the fourth quarter, and I think this just kind of goes to the point I'm trying to make, is in the fourth quarter, US had tremendous outperformance. I don't think it was quite 20%, but high teens in terms of the outperformance. And we saw a quick reversal in the first quarter of this year. International stocks really gained ground, ended up passing US stocks at the end of that first quarter. And I think it's just an interesting sort of commentary as to what we're seeing, maybe why we didn't chase international during that time. I believe I mentioned during the State of the Economy, but the outperformance of international in the first quarter was a 3 standard deviation change in terms of what we normally see. So almost like a less than 1% chance of that type of outperformance. And a lot of that was driven, through the tariff uncertainty, but also through currency changes. As the US dollar depreciated, that is generally when you see international stocks outperform US stocks, it's usually more of a currency issue versus economic strength of companies because you look at maybe developed international, Europe in particular, those are more probably defensive type stocks. You look at emerging markets, you might have some more materials, industrials, some emerging technologies. Those can be awfully volatile. But we still see, when we go back on a longer period of time, and especially over the last couple of weeks when the US dollar has actually appreciated, you're seeing the US stock market catch up and begin to do well. When we ran it after yesterday's close, actually that number came to about completely even of the US stocks versus the rest of the world index. So again, we're believers in the US stock market, and these next two charts will show you why we continue to have that bias, I would say. This is a chart showing, so this takes into account essentially all large cap companies around the world, and it breaks it into the top half of companies on their return of assets and asset growth over time. And when you look at the types of companies that are growing the most profitable companies, 72% of those large cap companies are domiciled in the US. Doesn't mean that there's not some good companies internationally, overseas, whether in Europe, emerging markets, you name it. But there's still that strong tendency to see some of the best run, best managed, and best growth companies in the US. And those are the companies we want to hold. It's not like we're holding all of that within the portfolio, right? We do have diversification. We do hold other types of companies. But when you kind of look at the outlook from here moving forward, and we've talked about it again, the AI revolution that I do think we're on the early stages of, that can be a huge driver of a future bull market. Those types of well-run growth companies are here in the US. And so we do have a strong bias there because we do think those are the environment in the US and the types of companies that are here are structured for the long haul. And so we feel very comfortable with that. And, part of the reason why we didn't really, reverse course in that first quarter, even though we saw some outperformance internationally, we're still managing this on a longer term basis. And we still like how the US is positioned. And lastly, just to that point, when we look at future sort of growth models, this takes into account future expectations for different sectors, the blue being US, red being Europe in this case, just kind of looking at the estimated growth during business cycles. In almost every case, you see, future growth in the US being forecasted as stronger than, somewhere like Europe. And again, I think European stocks did perform very well in this first quarter, but as always, we're looking into the future and looking at, what makes the most sense from here on out. We'll wrap up just, briefly, just kind of talking about market valuations and market sentiment. I do think, with all the positivity over the last few weeks, more clarity over tariffs, backing off of some of the, most detrimental tariff policies, we've had a great reversal. Like I said, the S&P is actually now positive year to date. We're still a little bit below where the highs were back in early February, but we're in green year to date, which is a great thing. But when we look at the two biggest indices in the US, the S&P and the NASDAQ, which are both circled here on the left side, you have the NASDAQ trading at about 25 times earnings. It's higher than the 25 to 75 percentile. It's not quite at the 90th percentile, but in general, on a historical basis, it's a little overvalued right now. When we look at the S&P, again, when we look at future earnings per share expectations, future earnings expectations, the S&P is trading pretty richly valued. And, that can be, a little scary at times, I guess, when you're investing at high valuations. Valuations don't always drive what the market's going to do next, especially in the short term. Probably has more of a longer term predictive value when you look at PE earnings and how stocks are trading from a fundamental standpoint. But I do think it's worthwhile to remember that right now markets are trading or priced kind of at perfection, right? Kind of minimizing some of the uncertainty that's out there. So again, we just want to take it into perspective, understand how the markets are trading. Again, we still think that there's a lot of upside from here, given some of the market data and economic data that Paulo was sharing, especially from a labor perspective. I think that's, as he said, it's really the foundation of our economy and really drives the strength of our economy. Still looks good, has still been solid. And like I said, if we get future growth from technology and productivity, especially because of the AI revolution that I do think we're on the early stages of, that can be a really, really positive as we move forward. So again, worth keeping in perspective, but there's two sides to that conversation as we look at it. On the positive sentiment here is that U.S. equity sentiment indicator is still, even after the growth that we've seen over the last couple of weeks, it's still negative. And that can be a good thing, right? Negative sentiment, sometimes, markets probably still have room to run, still have room to invest. So with that type of sentiment still out there, again, we think that's a positive for stocks as we move forward. And then just lastly, I think this is an interesting slide as we kind of look ahead. This just shows kind of the earnings growth estimates of Mag 7 companies in blue, the rest of the S&P 500 in green. And you see 2023, 2024, and then looking forward, 2025 and 2026, you see some of those earnings expectations narrow as we go forward. So again, it's not to diminish what some of those large cap growth companies are doing. And frankly, I think some of their earnings are being hurt because of how much they're investing in AI and investing in technology and infrastructure, which is all going to be a real positive as we move forward. But just to kind of show you that I do think there's going to be other areas of the market that will help propel this future growth in the markets forward. And we want to be aware of that and looking at how diversification has helped so far year to date, but also as we move forward into these next few years, I do think there will be some positives to that. And so just in closing, Paulo did a great job going through some of the economic data. Like I said, we've had that conversation of hard data versus soft data. The soft data has been really, really bad over the last few months. Hard data is actually coming in quite strong, both GDP, labor, earnings. They've all been a real positive. So I think they're going to be really important as we move forward, much more important than sentiment or that soft data. We went through valuations are high. So, to move forward, we do need to see some earnings growth to support that. Tariffs may have an impact. It's still hard to quite see. I don't think we've really gotten great data so far on what the tariff impact has been, and maybe it'll be minimal. But we still will favor some of those quality factors and diversification in this type of environment. As we look out, recession odds over the past few weeks have dropped pretty significantly. We're seeing it both from economists, and as we kind of remember going back to 2023, they're not always right on these things, but we're seeing it in other areas, right? Not only the stock market growth these last few weeks, but bond market. And the bond market's very, intricate, intelligent market, and we're seeing spreads narrow, which is a good thing in terms of what future outlook from an economic standpoint is. So this is all a positive. And as always, planning, staying the course tends to win out. We think those are the best strategies as we move forward. And, if us or any of our advisors on our team can help, review your plan, go over any questions you may have, either from this presentation or just what's been happening in the markets over the last few weeks, please do not hesitate to reach out to us. We are here for that, and we'll love to get together and chat with you. So with that, we appreciate everyone joining us today. Like I said, if you do have any follow-up questions, I don't see any in the chat or Q&A. If you do have any follow-up questions, please reach out to us and we'd be happy to discuss it with you. So thank you again. Thank you, Paulo, and have a great rest of your day.